हमेशा सुनते आए हैं कि कामयाबी का सूरज शहर में ही निकलता है। गांव का कच्चा रास्ता मंजिलों से कहां मिलता है। पर आज हम इस बात को बदलने वाले हैं, बनाकर एक कामयाबी का रास्ता सर उठा के चलने वाले हैं। नए मौके, नए इरादे, बने ये खुद की मर्जी के मालिक। ना रहेंगे सपने आगे। जो ठान लिया करेंगे हम वही, दिखा देंगे दुनिया को कि गांव भी शहर से कम है। जो अब तक ना हुआ वो कमाल करने वाले हैं। शहर भी देगा दाद जिसकी, हम वो मिसाल बनने वाले हैं। कुछ इसी इरादे के साथ स्पाइस मनी से हर गांव जुड़ रहा है। एक कामयाब कल की ओर बढ़कर लाइफ बदल रहा है, क्योंकि साथ स्पाइस मनी तो लाइफ बनी।
Yeah, sorry everyone. Good afternoon everyone. A warm welcome to the earnings Zoom webinar of Digispice Technologies Limited to discuss the results for Q4 and full year FY24. We have with us Mr. Dilip Modi, Chairman of Digispice, Mr. Sunil Kapoor, Full-time Director and Chief Financial Officer, Spice Money. Before we begin, I'd like to state that some of the statements made in today's discussion may be forward-looking in nature. The actual results may vary as they are dependent on several external factors. A statement in this regard has been included in the result presentation sent to you and also uploaded on the exchange earlier. We will commence the call with the management taking you through the operational and financial performance for the period under review, following which we will have an interactive Q&A session. I would now like to invite Mr. Dilip Modi to commence the presentation. Over to you, sir. Thank you.
Thank you, Amit. Good afternoon, everyone. Welcome to the Q4 and FY24 earnings call for Digispice Technologies. It's always a pleasure to connect with all of you, and thank you so much. I know time is precious for all of you, and thank you so much for giving us the time and listening to how we are progressing as a company. And being able to use this opportunity to give your feedback, suggestions, as well as any questions or clarifications that you may have. Thank you for your interest in Digispice. Friends, before I start, I want to share with you that, the last 5 years has been a very eventful journey for us at Digispice Technologies. As you know, we have evolved from a multi-business entity to now a very focused fintech business. We have, over the last 5 years, built a robust network of merchants across semi-urban and rural India. We started in FY20 at about 240,000 merchants. We've closed FY24 at close to 1.4 million merchants. So effectively, it's been a journey of 5 years where during and post-COVID, we've been able to light up a lot of merchants as effectively ATM banking points across 250,000 villages. This has played a significant role during COVID when subsidies were being given to consumers in rural India, and they were able to go to their merchant close to where they live to be able to withdraw the subsidy from their bank account. A truly transformative use case of the India stack, and we're very proud to have contributed to this journey of not only enabling consumers to access their bank accounts, but having done that, to now work closely with financial institutions to be able to serve those customers with many more products and services from the formal financial sector. So the COVID period has been a significant period for your company, where effectively we've been able to build out this network. And now looking forward to the next 5 years, we are hoping that we can leverage this network to be able to drive more penetration of formal financial services into deep rural India, which till today was not possible due to unit cost economics. And we are hoping that now with a network like ours in place, leveraging technology, we will be able to drive deep into rural India formal financial services. So with that, I would like to start the presentation. Can we have the slides, please? Can we go to the first slide, please? So the presentation is in 5 parts. I will take on the first 3 parts, which is our journey to date, talking a bit about the business and the services that combine to deliver the P&L. And then we'll have Sunil take us through the Spice Money and the consolidated financial highlights of the company. Can we move forward, please? So friends, if you look at our journey so far and the road ahead, effectively the left box talks about some of the key highlights of our journey to date, and the right box talks about where we are going. So let me first focus on the key highlights so far. So as I mentioned to you, to date, lifetime, we've onboarded about 14 lakh small merchants who we refer to as Spice Money Adhikaris on our web and app platform. Majority of them use our mobile app to deliver ATM and other financial services to consumers in rural India. Of these, 4 lakh merchants transact on our platform on a monthly basis. This is just an average number. If we look at the gross transaction value of the value of the transactions that the customers are doing on our platform, it has been about 1.08 lakh crore for the financial year 2024. And this number has grown at a CAGR of about 49% since FY20. So the last 5 years, we've seen a growth of 49% CAGR in our customer gross transaction values. And when I come to the slide of the growth of the network, you will see that it's kind of mirroring the growth in the network that we've had of the Adhikaris. This number of 1.08 lakh crore is the second year running where we've crossed 1 lakh crore in our customer GTV number, which is reflective of both the value of the cash withdrawals as well as the growing collections business on our network. And we'll talk more about that. Over the last 5 years, we've managed to achieve a significant PIN code presence, mainly in Tier 3, Tier 4, Tier 5, Tier 6 India, with over 6,000 blocks and 2.5 lakh villages covered with the merchants over there, and we'll show it to you on a map. Effectively, we are focusing on building a financial services stack for emerging India. Our core business is the Aadhaar-enabled payment services stack, where we have close to an 18% market share of the offers industry. So basically, within the Aadhaar-enabled payment system, there's an onus and an offers. Onus works where all the banks have their own kiosk network, and offers is where platforms like ours can work across different banks, which are interoperable. So effectively, there are 2 parts to AEPS, onus and offers. We participate in the offers industry and have a close to 18% market share. So as we think about UPI in urban India, we have AEPS in emerging India. And many of us who know the UPI numbers, 350 million unique users in UPI. In AEPS, it's about 150 million unique users who transact on the AEPS platform. Not only on the AEPS side, which is our biggest use case around cash withdrawal, we also have other offerings around utility payments, loan repayments, and also CASA and credit. So we as a platform business have moved also from payments business to banking and credit business, and we'll talk to you about that. This has happened through partnering with reputed financial institutions, with whom now going forward we are focusing on creating products which are needed for emerging India, especially on the credit side, and we'll want to cover that with you. And all of this works on our tech and data platform. So effectively enabling consumers to safely and in a secure manner, withdraw cash and deposit cash in their bank accounts is enabled through a very strong and focused investment in our tech and data platform. If you look at the right-hand side, the strategic vision that we have had basically 4 key building blocks. The first one is to consolidate our share of what we call our assisted payments business. So if you look at the payments industry in the fintech space, you have a self-serve payments industry and you have an assisted payments industry, and both are kind of coexisting and growing. We look at becoming a significant leader in the core assisted payments industry, growing our market share. And all of this we are hoping will drive operating leverage in our core business. A lot of this is happening because of the network that we've built out, the distributor channels that we've rolled out, and the tech platform that we are constantly investing behind, that we will continue to work on and use this platform to bring strategic products, especially around savings and investment, to the market with right set of partners. Today, we have a lot of consumers who are coming and withdrawing cash and depositing cash into their bank account. We want to move them from a cash economy to a digital economy. And to do that, we want to lead in with savings and investment products, which basically means creating incentives for them to leave the money in the bank account, because by leaving the money in the bank account, they can actually grow the money. And I think this will also play into our fourth building block of converting them or bringing them onto the UPI platform and creating the next set of UPI users out of emerging India. The third part of our building block on our strategic vision is our lending business. In our board meeting recently, where we adopted the financial results for last year, we've also passed a resolution and made the necessary announcements where we are looking to enter the lending business through a strategic NBFC acquisition within the company. And this is something where we are doing it strategically to create credit products for our merchant base, as well as other small businesses in emerging India. And we'll talk to you about this. And finally, one of the things that we are very excited about, though we have to figure out the product market fit and the economics here, because as you know, the UPI economics are still evolving. But really, the next generation of UPI users is the problem that as an industry we need to crack. And we believe that, we want to strategically use our PPI wallet license, which is now for the last 2 years become UPI interoperable. It was not earlier. So now, if consumers are putting money into a wallet, they can go and scan and pay using any UPR QR code. And we know that UPR QR code is now pervasive across merchants across India, both urban and rural. So we want to use this product and this platform to develop UPI-based propositions for both merchants and consumers. And really the problem we want to solve here is that there are lots and lots of inoperative bank accounts in the markets in which we focus on. So there are consumers who are still not sure about connecting UPI to their bank account, safety being one of the main concerns. Can we start them on that journey using the wallet license, the wallet product? Because now the wallet has become interoperable on UPI as well. So these are the 4 building blocks of our strategic vision. We see ourselves as a unique tech-led financial services model, constantly working to serve the growing needs of emerging India. So this is to give you a snapshot on where we have reached so far and where we are going. Moving on to the next page, just talking about the executive summary on the numbers for the financial year, and Sunil will talk in more detail later for us. But the 4 key numbers that we track are the customer gross transaction value numbers. So if you see, like I said, this is the second consecutive year where we've crossed 1 lakh crore in GTV on the customer transactions that have happened on our platform. It's been relatively flat here because of headwinds in the APS business. So only a 7% growth, 107,000 crores compared to 100,000 crores in the previous year. Effectively on gross margin, we've seen a growth on 2 components. Service fees, the main number that we track, which has grown from 154 crores last year to the previous year to 169 crores in the last financial year. You can see a portion of gross margin coming out of devices business. This has basically been a change in capitalization policy, because till FY23 we were capitalizing the devices and providing a right to use to the adhikaris. This is something that we changed as a policy in FY24, and Sunil will talk to you about this as we go through the financials. We've seen our EBITDA and PAT numbers grow in the financial year 24 compared to 23, and these are numbers that you can see. We've achieved an EBITDA of 14.2 crores for the financial year and a PAT level of 12.1 crores. This is for the Spice Money business. Effectively, the 3 key points I want to highlight is that we are constantly trying to keep our financial performance robust. It's a pretty challenging space, because we've seen significant headwinds in the APS industry, and this has basically been happening because there have been concerns around APS frauds. And we as a player in the industry have been working closely with all the stakeholders to control this. This has led to a lot of restrictions in terms of two-factor authentication, different limits set by the issuer banks, which has caused an impact on the transaction numbers. We've tried to counter this by growing our collections business, both the cash management business as well as the Bharat Bill Payment System business. So effectively, as you see, both these product lines on collections have grown significantly year on year, 54 and 90%, and we have details on this. And two new business lines in terms of opening Aadhaar eKYC-based savings accounts in emerging India. We've opened close to 3.5 lakh accounts lifetime to date, as well as working with third-party lenders to lend to our merchants on our platform, nearly about close to 100,000 loans that have been lent to date, and we'll talk to you. And the final point is that, as a company, like I said, we've been in multiple businesses. Last year, we took a decision at the start of the year that we will be a pure fintech-based company, and we took a decision to exit all the other businesses which were classified under the digital technology services segment, which now we refer to as discontinued operations in our financial results. So when you see the consolidated numbers, you will see the P&L of continued and discontinued operations. We're hoping as we go forward over this year and the next year, a lot of the discontinued operations will phase out, and effectively we will just be focusing on the continued operations, which will be our pure fintech business, Spice Money. Moving to the next slide, please. Just to give you a highlight of the way our merchant base has grown over the last 5 years, close to 240,000 merchants in FY20, now close to 1.4 million merchants at a 55% CAGR. If you look at the right-hand side, we are predominantly a northeast central focused company. That's where you can see the density of the network that we have. Obviously, we have points of presence across India, but the south and west is lesser dense. Going forward, we hope to consolidate in the north and central and east corridors. And also, if I look at the next 5 years, next 2 years are going to be more consolidating in our north-east central corridor, and the next 3 years also entering south and west. So this is a business that works with density, because at the end of the day, consumers are looking for, doorstep banking, and the idea is that how do we consolidate and build dense networks across districts and blocks of emerging India. If I move to the next slide, please. Just to give you a sense on how some of the key metrics have moved year on year. So effectively, on the 3 boxes, the top left, gross customer, gross transaction value. Year on year, we've grown 7%, CAGR of 33% over 4 years. Quarter on quarter, we've seen a dip of 6.5% on customer GTV. Flattish year on year on a quarterly basis. Service fee revenue, while we've seen a 2% growth year on year, quarter on quarter again, we've seen a dip of 6%. However, through product mix, we've managed to hold on to our gross margins. So if you can see, year on year, we've actually grown 10%, our service fee gross margin, while on quarter, we've had it relatively flat at about 0.5%. A lot of this impact on gross transaction value and service fee revenue is because of our APS business, which has seen headwinds, and I have a separate slide talking to you in more detail around our APS business. Moving to the next slide, please. We as a business continue to, create diversification, both in terms of product and geography. This is to de-risk the business from a single product concentration to a multi-product platform business. Effectively, if you see between the 2 years, the growth in our GM from 154 crores to 169 crores, we've seen new product lines begin to grow. So if you look at our core business of cash in, cash out, it's actually declined from a GM contribution point of view from 77% to 68%. And we've seen new product lines, especially if you look at collections. Our contribution of collections to gross margin has actually grown from 8% to 14%. Banking, something that we just started, a little over a year back, has actually now beginning to contribute 2% to our gross margin. And more importantly, something like subscription packs, are now contributing 6% to our gross margin. So what we mean by subscription packs is the merchants who are using our platform to do transactions. They are not only, getting, they are subscribing to these rental packs where they're paying us on for the month, and that basically leads them to do more transactions on the platform. So this is a way for us to not only ring fence our high transacting merchants, but also to attract other high transacting merchants in the industry. And as the AEPS industry goes through a consolidation, this is a hook that we are using to be able to grow our revenue market share in this industry. Moving to the next slide, please. I just want to walk you through a couple of slides product-wise because it's important to understand the key trends in each of our service lines. So let me start with AEPS, Aadhaar-enabled payment system. This is basically consumers coming to our merchants using their Aadhaar to withdraw cash from their bank account. So the way it works is our merchants who are using our app on their smartphone have a small biometric machine attached to the phone. A customer of any PSU bank or any private bank who wants to withdraw cash from their bank, instead of going to a bank branch on an ATM machine, comes to the merchant in their village close to them, gives their bank name, how much money they want to withdraw, and authenticates using Aadhaar. The money moves from the customer's account to the merchant's account, and the merchant gives them cash. We've seen this industry, FY23, if you look at the industry, it did about the offers part of the industry. FY23 was about 3,33,000 crores, and FY24 that's actually dropped 6% to 3,14,000 crores. Now, if you look at the right-hand box, the main reason we've seen an overall decline in the offers industry is because of major ecosystem changes, and there basically been two changes that have happened. One is implementation of 2FA, which is basically two-factor authentication. So what has happened in this last financial year is that for every transaction that the merchant does, not only have they to take the biometric of the customer, but they have to also put in their own biometric. So earlier what used to happen is that the consumer who wanted to withdraw cash used to come to the merchant and authenticate themselves using their biometric. Starting Q4 last year, for every biometric authentication that the customer does, which is put his thumbprint, it has to be accompanied with the merchant also doing their biometric authentication. So that's a two-factor authentication that's happened, and it's basically being done at an industry level to control frauds. What has also happened is that the issuer banks have accompanied this with putting various transaction limits in terms of number and velocity checks. And this is all a healthy sign of controlling the industry because we are serving a sensitive part of India where we want to make sure that fraud is under control. And as Spice Money, we're committed to bringing down the fraud to sales ratio in this industry. Despite the industry declining 6%, if you look at Spice Money GTV, we've actually declined 5%. So we are actually gaining market share, in the APS industry. So from 17.15%, we actually moved overall for the financial year for 17.34, but we actually ended Q4 last year at 17.53% market share. So our focus in this industry is to make sure that we consolidate and grow our market share and make sure that we can, focus on bringing in best practices and the right practices in terms of merchant onboarding, training, development, and also putting in the right checks and balances in partnerships with the ecosystem around fraud and risk. If you look at the transaction metrics, obviously these changes have had an impact on the transaction numbers. So that's exactly it's reflective in the GTV. And obviously, if you look at the SMA metrics, which is our Spice Money Adhikaris, we've split them into large, medium, small, which is basically those doing higher transactions compared to those who are doing lesser transactions. And we've definitely seen more drop in the ones who are doing the higher transactions because obviously that's where the footfall has been the maximum. And this is something that we will work on over this year. We can see things settling down in Q1 FY25, but this is an ongoing journey. This is something that we will see how the ecosystem evolves. But effectively, we are seeing consolidation in the space and the opportunity for a player like Spice Money to grow market share. If I move to the next slide, please. This is one of our two collection products. This is cash management service. Just to explain how this product works, these are lenders, e-commerce companies, logistics companies who are basically collecting cash in semi-urban and rural India. So most of them have their agents, whether it's the MFIs or the NBFCs who are lending in semi-urban and rural. You have agents going and collecting cash and bringing it back to their branches, who then go and deposit these cash in the bank branch, from the branch of the NBFC or the MFI. And you also have e-commerce companies where you have cash on delivery. Now, what has been happening historically is that a lot of this cash is coming to the branch and then from the branch getting deposited into the bank. Now, instead of carrying the cash from a village to the town to then deposit at the bank, what is happening is when they bring the cash to the branch, instead of depositing at the bank branch because it might be a holiday, the bank timings may not work, they actually come and deposit the cash at our Adhikari point and we move it to the bank. So effectively, if you see this business over the last 4 years, FY21 to 24, we've seen significant growth and it continues to be something that we are seeing growth in 54% year on year. So we closed at close to 27,000 crores in FY24. This is the gross transaction value of the collections done from the branches compared to 18,000 crores in the past year. Quarter 4, we did about 7,300 crores. We saw a slight dip. This is basically been that we saw a significant peak up in the quarter 3, which was the Diwali season, because you see a lot of growth in e-commerce in Diwali. And this year we saw that there was a dip because of that in terms of like a big sharp increase in quarter 3 in rural and a dip in quarter 4. But overall, we've seen a 54% growth. The other message I want to give on the slide is the box where, not only are we looking at the overall GTV, but also looking at what we're calling the large CMS SMAs, the Spice Money Adhikaris that we have. So I would encourage you to look at these as large collection centers, collection branches that are coming up for us. Overall for the year, about 7,300. So these are like effectively becoming like large collection centers, which are contributing nearly 90% to this GTV of 27,682 crores. So if you look at the whole year, the 7,300 Spice Money Adhikaris did a GTV about 24,256 crores out of a total of 27,682 crores. So effectively, if you look at the right-hand box, we've seen the number of large CMS SMAs increase 23% year on year. The business that they're contributing growing nearly 49% year on year, contributing nearly 90%, and we see headroom available. So this is a business that we will continue to move forward to, because this effectively allows a lot of enterprises serving rural India, whether it's in the lending or e-commerce or logistics space, to be able to convert cash to digital faster. So more business for enterprise, more enterprises, and more importantly, consolidating more large collection centers, we believe is the focus of this product line, which is cash management service. Moving to the next slide. This is what we call the Bharat Bill Payment System stack. This is operated by NPCI, the National Payments Corporation of India. This is something that is being built as a public stack for collections. So this is one of the DPIs, that we look at, the digital public infrastructure. We as a player are riding on this stack, and there are two key products we are focusing here: EMI loan repayments and electricity bill. So effectively, if you look at it year on year, overall, while we've grown 90% in customer GTV, 4,190 crores compared to 2,210 crores, which is about 1.8x growth. Within this, EMI loan repayments have actually grown 2.3x year on year, 3,160 crores from 1,325 crores. Now, the difference between this EMI loan repayment on BBPS compared to what we saw as as cash collection on CMS is that the agent who's going to the village to collect cash, CMS is when he brings the cash to the branch and from there deposits the cash at our Adhikari point. BBPS is where within the village itself, he goes to his closest Adhikari point and him or the customer deposits the cash. So directionally, we believe that our goal is not to get the agent to come to the branch in the town, but rather just deposit the cash in the village itself at the nearest Adhikari point. And that's the direction we want to move. If we look at the last page, we are about 63 partners here. There on CMS here, we have nearly 147 partners. This is a higher margin business as well and allows us to engage, with the agents and the customers in the rural areas itself. So this is a product line that we want to grow. If I look at the box, you would see that the unique customer accounts, have actually grown significantly, both year on year and quarter on quarter. So year on year, if I see FY24 to 23, 35% growth in unique customer accounts. But what we are most excited about is the growth in the repeat customer accounts, which is basically, an organic repeat behavior that we are beginning to see happen, where agents and customers are coming back to the same merchant to deposit the EMIs. And I think this is a good thing for us to drive better collections efficiency for a lot of lenders lending into rural India. So the percent of our repeat customer base to our unique customers is nearly 50%. So I think this is a very important product line for us. So AEPS, CMS and BBPS combined to create the assisted payment stack for the company. And so overall, if I look at it, all these three product lines are contributing to deliver us the 1 lakh crore customer GTV number that we saw initially. Now moving forward to the new product lines that we have. So current account, saving account is a product that we started about a year and a half back. This is something that we are working with some banks to figure out how to increase the reach of bank accounts to customers in emerging India. Lifetime now we've opened over 3 lakh accounts in semi-urban and rural. And what we are tracking here is growth in float in terms of people using these accounts. Let me again re-emphasize that our focus is not in terms of just opening an account, but getting to ensure that the customers transact with the account. We've had numbers on Jan Dhan accounts where, as a country, we've seen over 50 crore Jan Dhan accounts open. But the key issue is how many of those accounts are being operated. So our goal is to make sure that customers not only open an account, but transact with the account, which is basically, put money in the account, invest from that account, get loans into the account and use the account. So moving from a cash to a digital economy. So the two key metrics we want to track here is how much is the float coming into the account, so it gives us a sense of activity, but also figuring out which are our Spice Money Adhikaris who are using this to convert themselves from just an ATM point to effectively becoming a bank branch point. So we've seen Q4 last year, close to 16,000 of our Adhikaris who each opened about more than 5 accounts on a lifetime basis. So our focus is to focus on average bank balance per account, look at what are the kind of products we can work with the financial institutions to cross-sell in these accounts, and also to ensure that we can consolidate within our Adhikari base effectively what could function as digital bank branches for banks, where customers can not just come to open accounts, but also get access to multiple financial products from the institution using that account. So this is a journey of making sure that we can drive penetration of transacting, operating bank accounts in emerging India. Moving to the next slide, please. All these slides are actually available on our website. They have been uploaded on the stock exchange. For anyone who wants to look at it in more detail, please do go and have a look, and we'll be more than happy to come back with any follow-up questions you might have even post this call. Credit is a space that is very new to us, though we've been at it for the last 5 years. This is a space that we are being very, very careful on. We don't want to rush in this space. We want to walk. We've been crawling, and now we are hoping that we can start walking. There'll be some time before we start running, but we want to take it step at a time. We've had lots and lots of learnings. This is all third-party loans being given to our Adhikaris, and last year also to the Grahak, which is the customers coming to our Adhikaris. We've seen significant learning. So more than the numbers, I would encourage you to look at the box where we are talking about our key learnings, right? So the first key learning that we have over the last 5 years as we've been working in this space with our lending partners is that there is an inherent credit demand in the small merchant network that we've built of our Adhikaris. So Adhikaris are looking for formal credit. We've been able to discover that in the Adhikari base we've built. The second learning that we've had is that many of these merchants are okay and actually prefer the process and are getting used to this whole aspect of digitally applying for a loan, but they're looking for customized products with, more importantly, friendly repayment mechanisms. And if there is that friendly repayment mechanism, then it can allow for higher take-up rates. So I think there is a need for customized products is the other big learning that we have. The third one we've had is that we've seen, if you look at the graphs, we've seen a varied growth of credit over 5 years. And this has basically been because of continuity of products, changing policies, supply of capital, dependence on third-party lenders. So even though demand has remained consistent, supply has been erratic. And because of that, we are looking to also, have our own NBFC so that we can ensure that we can cater to consistent demand. So while we continue to, work with third-party lenders to make sure that the products that are beginning to work how do we make sure that we have the ability to manufacture those products on our own? The fourth key learning has been, two big differentiators we've seen in terms of successful products on our loan marketplace. One is, our ability to contribute to risk assessment with the third-party lenders, using our platform data. And the other thing is helping them on collections, because we have a network on the ground, we have feet on street, we have distributors with field sales executives. We know our merchants physically, our ability to also engage with them on collections. So if there is an overdue or bounce rate, we can actually go and physically engage with them to figure out what are the issues. And most of the time we realize that more than intent, it's just an issue of timing. And, we can help our partners to collect better. Also, last year we started with our Grahak loans, and where we are beginning to see success is on secured products, like gold loan. And this is something that we're going to work on. But like I said, this is a very critical space in the overall financial services industry. We've seen significant amount of innovation in the space. The last time we saw it was the microfinance industry. And we are hoping as Spice Money, with our phygital model, where we have our physical merchants enabled with a digital platform, how we can create a more robust, secure, safe credit business. So, all the learnings we have around consistent source of credit, the need for tailored products, the need to ensure that we can manage risk effectively, both with data as well as on the ground presence, and continue to make sure that we have a strong collections capability on the ground are key to driving for us a tech-led rural credit business. So that brings me to the next slide, which is around the, how we are thinking about the credit business going forward. Our goal at Spice Money is to build a productive, empathetic credit business for small businesses in emerging India. If we have to move towards a developed Bharat, a Viksit Bharat, we have to ensure that, more and more small businesses can thrive. And a lot of the MSMEs, especially the micro part of the MSMEs, are residing in emerging India, semi-urban and rural India. How do we use all our learnings to date? How do we use the tech stack, account aggregator, Udyam Aadhaar, all of these now tools that are available to us as a fintech player to solve for formal lending to small businesses? But we believe that what is happening today is, when you think of banks, they either talk about branch banking or mobile banking. What we believe emerging India needs is a combination, where effectively it is both physical and digital. The challenge is, in trying to do both, how do you solve for unit economics? Because setting up a branch has significant fixed costs associated with it, and purely going digital, has its own challenges. And the regulator has been very keen that all players in this industry work very responsibly to make sure that we can build a very strong, viable lending business. So for us, the opportunity is, because we have this digitally enabled merchant network on the ground, we are uniquely placed to build a physical plus digital model as we think about the lending business. So our differentiators, the way we see it, is to begin with product innovation, where we are learning as to what are the right products for consumers, especially small businesses, the merchants that are on our platform. Second is our proximity, our physical proximity to our borrowers. So on the earlier slides, I spoke to you about building a dense network. What a dense network allows us to do is have access to the merchants on the ground. And this hyper-local connect with our merchants, with our extensive distribution partner network, allows us not only to source, but also do proper KYC and also in collections. So what we believe is that this asset-light, kind of branch network that we are building out with our distributors and retailers on the ground, who can effectively become both borrowers of credit and distributors of credit, enables us to ensure that we can build a robust model. So we're not just looking at evaluating them using data, but we're also looking to, do the personal discussions, which would also be physical discussions on the ground. So a combination of both branch and mobile banking. And finally, around ensuring that we have an enhanced risk management framework, where we continue to build not just on building scorecards around using data, but also local intelligence, and making sure that we use the local intelligence to not only improve on our ability to assess risk, but also use our infrastructure on the ground to be able to do better collection. Overall, I would say this is a very new space for us. We're going to walk this space with a lot of care. a step at a time. We're not going to run too fast. We're going to make sure that, we use this very effectively to build a sound business. This is a long-term business, so I will not commit to any short-term numbers here. This is a business over the next 10 to 15 to 20 years that we want to build, and we will build it brick by brick, block by block. So with that, I'll be more than happy to answer any questions later, but I'd like to hand over to Sunil, who can walk us through the financials of the company. Over to you, Sunil.
Thanks, Philip. Good afternoon, everyone. This slide contains about the Spice Money financial highlights, standalone business. And if we see on the left-hand side, we have a last 5 years, including this financial year ending 24 performance, side quarter-on-quarter performance. If we see that we have grown our customer GTV, if we see customer GTV has is increased by 4%. However, our gross margin has improved by 10%. The reason of the gross margin improvement is primarily coming from the subscription packs, by which we are aligning and engaging more with our agents on the ground, adhikaris on the ground. And if you see on the gross margin, device or subscription for devices has kind of come down to zero. Even then, we have increased our gross margin. This is the practice which we were following in the last years, was capitalizing the devices and charging to our adhikaris as a service fees and taking it to the P&L. And we are owning that those assets, those devices in our fixed assets, and carrying it out as a depreciation. And that can be related to the depreciation also on the below line of the EBITDA. So it is very clearly coming out that we have discontinued as a gross margin. We have reduced it to kind of almost zero, and we are now just selling those devices almost a nil margin because we don't want to earn on the devices. That's why this is subscription devices has come down from 11 crores to zero. And if we see on the indirect cost for the year is 148 crores, down from 155 crores. So we have kind of come into the play of operational efficiency, and by which we are not increasing our kind of fixed cost and increasing our gross margin. So that has improved an EBITDA almost by 100% from 10.2 crores to 21.7 crores. And due to the lesser depreciation, but what I have explained, our EBIT is also from 2 crores to 36 crores in this financial year. And consequently, the PAT from 5.7 crores to 13 crores. If you see the quarter-on-quarter numbers also, that in comparison to the previous quarter, though there is what Dilip has covered about that the two-factor authentication and the industry changes, which I understand that on the ground it has been adopted by now fully, and that impact has also phased out. And we have done a gross margin of almost flat, 42 crores in the previous quarter and in this quarter also. But our indirect cost has come down with some measures what we had taken, and thus our EBITDA has improved improved from 4.3 crores to 8.8 crores, which is a 100% jump. And depreciation, we had taken some accelerated depreciation. That's why this at the end of the year, and that's why the depreciation is on the higher side. And consequently, EBIT is from 8.7 crores to 10.9 crores, and PAT 4.2 crores to 5.9 crores. Can we move to the next slide, please? This slide contains about Spice Money business, which is also reflected here in two segments, Spice Money and others. I have already covered about Spice Money in the previous slide. Just pointing it out about the others. These are the others which is not directly related to Spice Money, but as a overall company, what we are overall group at a Digispice level, what we are incurring the expenses. So that is also in line with the earlier previous year and previous quarter numbers. And if we see that the impact of the if we see that other EBITDA and the others line is 7.1 crores negative in the last financial year. Now it is a 7.5 crores, so it is in almost in line. And EBIT is also 1.4 crores to 1.8 crores negative, and consequently the PAT is also 1.4 crores negative. There is a extraordinary gain. We were having an investment for which we have provided through a note on the right hand side. We had an investment in DG Asia Bias PT Limited, and this company has got listed on the Nasdaq, and kind of that's we have to evaluate our investment again, and this is only a unrealized gain, just to recognize it in the conformity of with the Indian accounting standards, which requires it to be fair valued. So this gain has come up. We have shown it as an extraordinary gain separately, and there is a PAT for the discontinued business for the year is 38 crores, and for the quarter it's 4.3 crores, which I will cover in the next slide. And considering all impacts, the total PAT, even the discontinued business and extraordinary gain, we are at 12 crores, 11.8 crores against the 21.6 crores negative in the previous year. Can we move to the next slide, please? This is a summary of the discontinued operation, which we had discontinued in the May 23, and we are phasing it out, this operations, discontinued operations. And if we see for the full financial year 24, if we see there are two major items of tax expense, which was having which tax expense and exceptional items, which are the balance sheet kind of expenses written off, which has no impact on the cash outflow. And if we consider out that on the revenue and the expenses from the next quarter, there will be no revenue, and consequently no direct cost, and consequently indirect cost will also come down. However, almost 50% of this indirect cost may be running quarter on quarter to kind of close down those companies where these discontinued operations was there. So overall profit PAT was 38.1 crores negative for the full financial year on the discontinued operations. And now I can hand over this to Amit for the Q&A. Thanks.
Thank you, Dilip. Thank you, Sunil. And now we open the floor for the Q&A session. Request all participants to raise hand before asking a question. At the same time, participants can also ask questions by writing in the chat box. We'll wait for a while we have the question queue assembled. Request all participants to raise hand or write in the chat box to ask a question. So we have our first question from Rishu from the chat box. Expected expenses on closure of companies / indirect cost for legacy business in upcoming quarters. Any ballpark range on absolute numbers? So I think there are two parts to this question.
So I have, Rishu, thanks for this question. I have already covered in my presentation that we are incurring 4.2 crores of indirect expenses for the discontinued operations for the quarter. And we expect that will come down to kind of half, because some of the revenues are also, some of the expenses are also related to the revenue generation also. So those indirect expenses as the revenue has been discontinued from the next quarter, and so the indirect expenses will also be reduced. So I mentioned it out that this will reduce to kind of half for the quarter.
So second part of the question was any ballpark range for absolute numbers?
Yes, that's why I said that will become half of that.
Sure. The second question from Rishu again is, as we are moving away from legacy business, are we thinking to rename company to Spice Money instead of Digispice?
So thank you for that, Rishu. I think, effectively, if you see, Spice Money has become the only business of Digispice Technologies. So effectively, it's become the brand and the product of the company. The name of the company is something that we can think of subsequently, but effectively, directionally, this has become the brand and the name that we are growing with. I think we'll come back on this issue of renaming the company. But effectively, Spice Money is the only business of Digispice Technologies now.
Thank you, Rishu. Next question is from Rasagya Gandhi. There are two questions. What are the company's plans for fundraising? And what are your views on the fee-based income increase?
So let me take the first question. Rasagya, thank you for your question. So I think if you see, effectively as a company, we have been a profitable company, not significant absolute profits, because we've been reinvesting in building people, tech, and we've grown as an organization to now close to over 1,000 people, especially because we had to, roll out a large distribution network. As Sunil outlined in the financials, now we are beginning to see the fixed costs kind of taper off, and therefore the operating leverage flow, and therefore more, hopefully, as we see business growing, we'll be able to see the impact on profitability. So we are in no rush to do any fundraise effectively. I think for us, we want to make sure that first the business model stabilizes. Like I said, there have been headwinds on the APS business, but we're seeing the collections business grow. We are looking at, learnings from the credit business and how do we build on that. Directionally, there might be need to think about fundraising for the credit business, but something that we're going to come back on. I think right now our focus is to make sure that we drive operating leverage and make sure that many things on credit and banking, especially, on the credit side, we are able to, build products that work using our own capital, maybe work in some sort of a co-lending model, but initially just work with some of our own capital, and come back to investors once, we are seeing the numbers on the new products, especially stabilize. On the second question, Sunil, you want to take that?
Yeah. On the second question, that's on the fee-based income increase. As we are introducing more products and services in our portfolio, of course, the fee-based income will get increased. And if you see that from our financial numbers, if you see that gross margin has kind of 30% to now is 40 and 41% in this quarter. So with the product mix and introducing more better margin products, we are going to increase our gross margin and also the fee-based income.
Thank you both. The next question is from the line of Lalit Agarwal. Can you share a financial of Spice Bulls Investments Limited?
I think this is something where this is a process that we're going to go through, and in this process, we are going to, of course, our first step is to apply to RBI for a change of control, which we are going to do in this quarter, and then follow the relevant steps of this acquisition. But anything on financials is something that I think this is available, but I would assume that as we run through the process, at the right time we'll be in a position to share this. So effectively, this is something that we will share, as part of the process going forward, on the acquisition.
Thank you, Lalit. Next question is from Harsh Sharma. Why is the GTV growing at a higher rate compared to the revenue?
I think this is a function of the product mix, but Sunil, you want to talk about that? Because collection business versus AEPS.
Yes. So you have rightly mentioned about that it's a nature of the product mix, due to which, because we are doing a CMS business, which have a kind of a more in terms of GTV standpoint of view, but having a lesser margin in comparison to other products. So it's always product mix plays about that. But GTV is also relevant with respect to that how much transaction value we are handling.
Thank you, Harsh. Before we move on to the next question, I'd like to request everyone, in case they have any question, they can raise a hand or put their question in the chat box. The next question is from Pradeep Chaudhary. What growth you are planning for each segment, AEPS, collection, etc. for FY25?
Okay, so Pradeep, I think if we go one by one on AEPS, we continue to want to see how the industry stabilizes. The two-factor authentication impact of last quarter, is still continuing to have an impact, but I think the merchants are getting used to the two-factor authentication process, so I think that will stabilize between this quarter and the next. But the impact on the AEPS business will be really a function of how this stabilizes. There is also a move that is happening from L0 devices, the biometric devices, to L1 devices, and we are working with the merchant base to drive that adoption. So I think that, effectively this year is going to be little mute in terms of, the impact on the AEPS business, but our growth is going to be to grow counter share. And that's what we're going to focus on. Collections is a key business for us, but it is a B2B business. So it's heavy lifting on the ground in terms of working with the enterprise agents to map them to collection centers that we have. So it's a business that's growing steadily, not a hockey stick, but steadily business growth. And we are hoping that we'll continue to grow it. So I think on AEPS, the focus is on counter share, and on collections, just growing in terms of more business for enterprise, and hoping that we can add some large enterprises, to the kitty in the coming year. But, something to watch out for quarter on quarter as we move forward.
So the next question comes from Harsh Sharma. There has been no fundraise indicated but for the NBFC business, what are the plans? Any AUM targets for FY25?
So, Harsh, for FY25, first there's going to be a process we have to run to close the process of getting the NBFC license under the LISCO. So that process in itself will take some time. And I think this year is going to be significantly first to get the NBFC under the LISCO, because it involves various approvals and all that, and we have to see through that. So I don't think we put any AUM target for this financial year. I think our focus is going to be first to complete the process of acquisition, and once that's done, we're going to start by a few products which we know have worked on the marketplace that we can work with our own capital, and we're going to test out those products with the NBFC. So I think this year, Harsh, is going to be closing the process of acquisition, and maybe in the last quarter, testing out some products through the NBFC. So we'll talk through this, Harsh, and give you an update in the coming quarters.
Sure. Thanks, Harsh. We have a question from Pradeep Chaudhary. What time frame you have in mind in lending through your own NBFC, and how would you be funding that?
Yeah, I think I just explained this point that next 2 to 3 quarters that we are looking to complete the process, and then once that is done, I think initially we will start funding through the own capital in the LISCO, because it will be more to demonstrate, create proof of concepts, put the systems in place. And of course, after that, we'll come back on any fundraising plans that we would have as a company, given the performance of what we've been able to demonstrate.
Sure. I would like to take the next question from Lalit. Thereafter, Harsh and Pradeep question can be combined. Lalit's question is, what is our equity holding in Digi Asia Bios PLL Ltd after the rights issue we subscribed?
Lalit, it's a little about 3%.
So next question, I'll combine Harsh and Pradeep's. Is also any guidance for the UPI segment? Last Concall you talked about taking UPI to hinterland.
So Pradeep, this is something, Pradeep and Harsh, this is something that I think as an industry, NPCI is very keen to see with 350 million UPI users now, where will the next 300 million come from? Now, basically, the way UPI works, as you know, the first thing is you need to have money in the bank account for you to do UPI. So I think our first goal is to ensure that we can have operating bank accounts in emerging India, where there's money in the bank account so that people can use to then transact with the bank account using the UPI rails. We are very clear in terms of the opportunity that we see for ourselves, because we have access to all these customers. And by the way, 30% of our customers who are transacting at our merchant points have a smartphone. So there is an opportunity for us to move them to UPI. So we are very clearly committed to it. I think our PPI wallet is going to be the first product where we're going to be testing with some of our customer base to see how they can start making UPI payments through the wallet. And there we'll be testing for customers who are today feeling unsafe to attach their bank account to UPI. Can they pay through the wallet because they feel that it's a more secure account to do UPI payment from? This has been a vision of the NPCI and the regulator to enable UPI on PPI, and that is something that we're going to be testing for in the coming year.
Before we move into the next question, another request from participants. If you want to ask a question, you may please raise your hand or put your question in the chat box. The next question comes from Lalit Agrawal. Can you please share business model of Digi Asia Bios PLE Ltd?
So Lalit, Digi Asia is a fintech based out of Indonesia. Effectively, if you see, Indonesia is a very large market in Southeast Asia. Digi Asia has been focusing on, again, building a merchant network business in Indonesia, but their model is more around, working between the merchants and the suppliers of goods to the merchants. So they've created a platform for the merchants, and they've built products which allow them to provide, lending solutions between merchants and, the suppliers who supply goods to the merchants. Unlike India, which has this UPI stack and all of that, Indonesia is still, a bit behind in terms of, having such a stack available as a digital public infrastructure. So effectively for Digi Asia, they're able to work more in a kind of a closed garden between manufacturers and merchants. So a lot of their business model is linked to connecting manufacturers to merchants and managing the payments and the lending solutions between them and earning from that business. So I think for us, we see in Digi Asia again a large kind of merchant acquirer platform in Indonesia, which is a significantly large market. Given the fact that they are listed on NASDAQ, there's also information now available in the public domain, which you can get access to, Lalit.
Thank you, Lalit. Another request, you may please raise your hand or put your question in the chat box to ask a question. Next question is from Pradeep Chaudhary. What time frame for UPI wallet? Is Digispice Asia a supply chain lending?
So UPI wallet, in the Q2 is where we see us being ready to, run some pilots around the wallet. So we'll have more update for you, at the end of Q2. On Digi Asia, PT Indonesia, so what they've done is they've actually created a digital platform between merchants and manufacturers. So yes, supply chain finance is one of the business models or one of the products that they have, as part of the business.
I'd like to request participants to raise their hand to ask a question or put their question in the chat box. One last request from the participants to raise their hand or put their question in the chat box to ask a question. So I think that was the last question. Now I'd like to hand over to Mr. Dilip Modi. Okay. So there is a question from Pradeep again. What is your stake in Digispice Asia?
Pradeep, it's a little over 3%.
Okay. So we have a question from Rahil Shah. Any growth guidance for FY25 or over next 2 to 3 years for the company as a whole?
So Rahil, I think for us over the next 5 years, we are seeing, one is directionally from, having a few products to building out a complete full, stack around financial services. I think we started with ATM banking, we've moved into collections, and then we started opening bank accounts, then looking at cross-selling, saving and investment products in those bank accounts, and now moving towards credit. So I think if you see directionally, Rahil, we are moving from becoming a single product to a multi-product platform business. The NBFC and the PPI just add our ability to manufacture more products of our own, which we can enable through the platform to merchants and consumers in emerging India. And so I think we will continue to move down this path, Rahil. I think it's going to be a lot of, consolidation of the ATM business in terms of counter share. It's going to be scale up of the collections business. So overall, we are hoping that this will drive profitability in our core assisted payments business. But directionally, we know that, a lot of digitization is going to happen in emerging and rural India as well, where people are going to move from cash to digital. How do we participate in that? And how do we solve for credit? That is something that, Rahil, we're going to work on over the next 3 to 5 years.
Thank you, Rahil. We have next question from Nikhil W. How do you generate revenue in cash management services?
Sunil?
Sorry.
So the question is from Nikhil W. How do you generate revenue in cash management services?
So, cash management services is primarily a cash drop services through our agent, where the MFIs and others, NBFCs or the banks, drops the cash at our counter, for which we charge as a fee. This is also under the BC arrangement, and also we are having a direct arrangement with the banks. So that's a revenue model, and we share that margin with our adhikari and the distributor network.
So next question is from Lalit Agarwal. Can you share the total debt in our books as of March 2024?
So, as far as total debt is concerned, effectively we don't have any debt. Only debt or the borrowings which is coming under the financials is against our OD FD just for the treasury management. Effectively, we don't have any debt. We are a kind of a debt-free company. We are having debt in the form of borrowings only for our treasury operations, OD FD operations, because we have to open more and more collection accounts with many banks. For that matter, we have to have a OD/FD operations. As per the RBI guidelines, we can't open collection accounts with any bank. So this is the reason of whatever the borrowings coming in the financials.
Thank you, Lalit. Next question from Rasagya Gandhi. What are the risks from banking sector as the banks are going digital themselves?
Rasagya, this is a very good question. Thank you for this question. I think, if you look at the banks, Rasagya, they basically look at two channels, right? The branch banking channel and the digital banking channel. And they've done a tremendous job on both channels, right? So you have a lot of consumers, even in semi-urban and rural, using the digital banking apps to open accounts, to get access to products and all of that from the banks. So I don't think this is a journey of one or the other. I think it's a collaborative journey. The we are trying to solve, Rasagya, is, for consumers who are still not finding it comfortable to just deal with the bank digitally, Rasagya. So effectively, we are creating a model, Rasagya, which is not just digital, but also physical. Where consumers do not just want to engage with the bank on an app, but also want to visit a branch where they can engage or interact with someone. We believe that Spice Money, with the merchant network that we have, a certain part of this network can evolve towards becoming a digital branch network for the bank. And therefore, this is a service that we can offer to the banking sector. For the banks themselves to roll out branches in rural and semi-urban is going to be very cost prohibitive, Rasagya. So I see an opportunity for us to actually collaborate with the banking sector. So what's happened today? Today, when we look at our core business of ATM banking, we are enabling banks to extend the reach of their ATM network to villages of rural India, right? So effectively, before players like us or before the AEPS India stack, you had about 2.5 lakh ATM machines in the country. Now you have about 20 lakh merchants who are transacting using the India stack and the AEPS platform. So effectively, it's allowed the banking sector to extend the reach of the ATM banking. What are we able to do with collections, right? It's enabling banks who are today lending in rural India through MFIs and all that to reduce the cost and time effort to collections, and it's all helping the banking sector. Similarly, when it comes to bank, opening accounts and giving loans and all of that, the banks have two options. Either they open branches or they only go pure digital. We believe the solution for rural is not one or the other, but a combination. But the challenge is economics. And therefore, we are solving for better branch economics for rural India. And that is going to be, we believe, a major contributor that could play in helping banking sector to extend reach of formal financial services to rural. So Rasagya, for us, we see banks as a partner in helping us to grow business, leveraging the tech-enabled merchant network that we have.
Thank you, Rasagya. Next question is from Joseph Matthew. Can you elaborate on any new partnerships or collaborations that the company is exploring to enhance its fintech offerings and market reach? That's the first question.
Okay. So Joseph, for us, being a platform focused on delivery of financial services in emerging India, we continue to seek partnerships with banks, fintechs, NBFCs, all the three key players in the ecosystem. Going forward, we also hope to work with, players who operate, like wealth management companies, mutual funds, insurance companies. So effectively, as we are able to figure out ways to sell products across the financial services industry, we will be reaching out to players within the industry. Initially, of course, our focus has been working with banks because ATM banking involves us to work with all the banks. Collections is now enabling us to work with MFIs and NBFCs, and we'll be working to partner with more and more of them. I mentioned that we want to work with some of the large NBFCs as well in helping them to reduce time, cost, effort of collections in emerging India. And then as we think about, building savings, investments and lending products, I think we're starting with a lot of the fintechs because they are a lot more risk, they have more capacity to innovate and take risk and therefore demonstrate that, these products could work. And then once they demonstrate the products will work, some of the traditional players can also enter. So it's a product by product strategy in terms of partnership and collaboration.
Again, second question from Joseph. Given the focus on EBITDA and PAT improvement, what cost management strategies are being implemented to optimize our operations?
Sunil?
Joseph, our approach is to have a better operational management with respect to the cost, and that's why I mentioned about the operating leverage. And we want to contain it, and our model is also from the perspective that we have to have a better cost managed because we have to deliver those services which banks and other financial institutions are unable to provide, as Dilip has also mentioned about that's the branch setup and the cost. So we have to have cost efficient in terms of delivery of the services, and also at the indirect cost level. Also, we have to have a limited cost to provide better services and have gross margins. And you have seen that on the gross margin front also, we have improved our gross margin through product mix and other efficiency put in place. And also on the indirect cost, what we had in earlier our calls, we have mentioned that we are investing in the some leadership and capabilities to be built. And now almost that has been fulfilled, but there will not be much expense on that side, and we will have a better cost management going forward.
Thank you. Next question comes from Utsav Baheti. Sir, can you please talk something about the legacy business in terms of till when will the cash burn keep on reflecting in the P&L?
The legacy business, as you call it, we've been in this business for 10 years. So our annual reports, we have so many companies across so many countries. Last year, when we took this decision of exiting the legacy business, what we are now calling the legacy business, it involved us. It was mainly a B2B business. So it involved us, transferring a lot of the contracts, which we mainly had with telcos, to third parties. That took a lot of effort and time. And now it's about, closure of these companies. We're trying to find solutions where we can, keep the cash burn as minimal as possible, as Sunil mentioned some numbers. But there is cost to closure. And what I've realized the hard way is it's easy to set up a company. It's more difficult to close a company. So I think, these are learnings that we have. And I think, we are hoping that, we can keep the cash burn to as low as possible. But there will be some cash burn. So as far as reflection in the P&L is concerned, Joseph, I'm hoping and assuming that, maybe for sure this year, but maybe a little bit of next year, we are hoping that, we'll be able to exit legacy businesses in terms of closing. So exited the business. So we're not doing any business. So we can't see any revenues coming out and any direct costs associated with the legacy business. But the indirect cost, which is associated with closure of the companies, is something that will continue to be. How will we reduce the cash burn is a journey we are on, and our attempt to service to keep it as low as possible.
Thank you. We have a repeat question from Joseph Matthew. How much budget is allocated towards the tech and innovation part to support the fintech platform's growth?
Joseph, again, a very good question. Thank you so much. I think for us, we brought in a new chief of product and technology, Harsh Mittal, from the tech space, and we've been working closely to figure out how to look at tech and innovation. As you know, there's been a lot of innovation happening even on the digital public infrastructure. ONDC, even CBDC, wallets, central bank digital currency. We've had the regulators and the governor talk about how that can be used for financial inclusion as a programmable wallet for subsidies to be given to people in rural India. So I think tech and innovation is going to be a major part. I think in this coming year and the next year, we've actually allocated a good number, for tech and innovation. And it's mainly in the form of, hiring tech talent. I think if I look at the PPI business, that will involve hiring of tech talent. If I talk of some of these new projects that we are doing in terms of modernizing our tech infra, that's going to involve hiring of tech talent as well as some investment in product management capabilities, as well as in tech tools. The good capex is that, with everything moving to the cloud, I think there's opportunity for us to build a very asset-light kind of, more a shared tech infrastructure. But I think there's going to be investments involved in people, with different skill sets. And a lot of work that they're going to be doing will not immediately show up in revenues, especially on the UPI side. So we're going to, maybe we can start segregating that separately in our P&Ls going forward. But yes, Joseph, for us, the next journey is around, leveraging, the ecosystem, both with respect to partnerships as well as the India stack to drive innovation.
Thank you. Before I move on to the next question, I request participants to raise their hand or put their question in the chat box to ask a question. Next question comes from Pradeep Chaudhary. What is the status of your development with Wibmo?
So Pradeep, as I mentioned, Wibmo is working with us on the building out the UPI stack for our PPI product, and we should be ready to start our pilots in Q2 this financial year.
I think that was the last question. Before we close, I would like to hand over the call to Mr. Dilip Modi for his closing remarks.
Thank you, Amit. Thank you, everyone, for taking time out. Like I said, we are a young company. We are work in progress, and we are wanting to make sure that we continue to serve underserved consumers in emerging India. A lot of what we built has enabled a lot of people in emerging India to, build businesses, and we are basically solving for small businesses to grow in semi-urban and rural India. We will continue to be on this journey. And thank you once again for your interest, and hope that we can, you can continue to be, showing your interest in the journey that we are taking. Please do reach out to us, with your suggestions, inputs, comments, because we all are on a learning curve. And as we build this company, we just want to make sure that we are building a healthy business, a long-term business, and a sound business which can impact, real lives on the ground. So effectively, we are building a for-profit impact business, and I'm really excited that, you have shown your interest to come on these calls and listen to us about our progress on this journey. Thank you so much once again. All the best. Namaskar.
Thank you.